Hey, Bostic of the Federal Reserve just argued for a 1 interest rate cut from the Federal Reserve. It's going to have some pretty big implications for the economy. A lot of folks already thinking that the Fed needs to do more to respond to rolling recessions, or maybe a big recession that we're either already in or going into. Who knows? The stock market had a big rebound today. Is that why Bostic's U-turning today? Let's listen to it and find out. Here's the interview.
The president came out a short time ago and said the Fed should lower interest rates. When he talks, do you listen?
Well, we hear lots of voices. I would say my job is really to talk within the 6th district and see where policy should go based on what I'm hearing in terms of the momentum of the economy. And today, what I would say is there's a lot of uncertainty. Forecasting is maybe a bit more challenging than it's been in the past. But look, I stay on my job to just talk to the business folks that we see and hear from them to understand sort of what's happening on the ground. And that really is the thing that informs me very much.
Well, this is the part where I'm normally going to try to pry out of you some sort of guidance on future interest rate moves. But when you look at the summary of economic projections, the dot plot from last week, one gets the impression that you don't really have a clue at this point.
Yeah.
Well, you know, what we've heard and what I've heard is that we don't really know where the economy is going to go. Business leaders don't.
Okay, this I think is so crazy that, the Fed has 2,000 economists researching this stuff. And the answer is, yeah, we don't really know. Good luck, bro. Dude, the Fed has given us guidance since like 2008. We're good. We project things are going to be good. It's only been recently that they're like, yeah, we have no clue.
Don't know, families don't know, and local policymakers don't know either. So one of the things that really has impressed upon me is the idea that people are taking on board information as it occurs. What they're hearing are things that are leading to expectations that there'll be upward pressure on prices, so that inflation will happen longer. And I've taken that on board. So my projection of where inflation is going to go this year is pretty much sideways. And we won't get back to a more neutral level of inflation, our 2% target. I don't project until sometime early in 2027. But
wow, 2027. Right now, PCE is 2.5%, at least per Powell's comments last week. We do have another PCE release coming this week. I think it's the 28th that we have the other PCE release coming out Friday. But the point here is that Bostic's like, oh yeah, man, it's going to be another 2 years before we get inflation down. Now that's remarkable because that's going to weigh on a lot of interest rate sensitives. The solar industry, the auto industry, to some extent, the real estate industry that has been overbuilt in many markets. These markets could continue to suffer. Now, they could continue to create buying opportunities for people who have cash, but otherwise, higher rates for longer, they could also set up for a Fed that isn't responding to real underlying weaknesses that are happening in quits or jobs or, frankly, with corporate earnings. If we start seeing a rollover in corporate earnings, now all of a sudden the hard data is coming in as a miss, and that's when businesses really start cutting back. We do not have a lot of room right now for layoffs, and the Fed's going to have to move really, really fast if there are layoffs. So far, no major layoffs yet. Knock on wood, because that causes a lot of human suffering.
But it is very much hearing people take in the latest news, figure out what that means for them, and then I will respond to that in terms of how I think about the economy's trajectory and policy.
Last month you said you thought...
This is ordinarily where you would hear them say, we have 2,000 economists that helps out. Apparently not.
That we would have 2 rate cuts this year. The dot plot didn't change, still calling for 2 rate cuts, but a number of people moved their dots up to say maybe we get fewer than that. Were you one of those?
I was one of those. So I was at 2, I moved to 1, mainly because I think we're going to see inflation be very bumpy and not move dramatically and in a clear way to the 2% target. Because that's being pushed back, I think the appropriate path for policy is also going to have to be pushed back in getting us to that neutral level.
Well, some of your colleagues also moved their dots down, suggesting that we might see more rate cuts, probably because they think the economy will weaken. What do you think the odds of an economy weakening because of fiscal policies are?
Well, what I would say is I am hearing more concerns about the trajectory of the economy. That's undoubted. But what I also will say is the data that's come in to date has not actually shown that, and we've still seen a resilient economy.
I mean, this is interesting because what you're really doing is you're saying, look, the data last month was really, really bad. The data this morning was okay. I mean, the service is still contracted to the extent that they're not growing at the levels that they used to. They're still positive, though, on the services side. Manufacturing fell into actual contraction again. But you're ignoring now the bad data that we've gotten, and you're saying, well, today's was good. Everything's fine. Not even mentioning the bad data. Interesting.
I do know that consumer sentiment has started to take a dip. And the question that we face right now is consumer sentiment going to be a leading indicator like it was pre-pandemic?
That's true.
Or is it going to be something that doesn't really translate into actual observed behavior in the economy that as how it played out for most of the pandemic? Right now it's an open question, and it's one of the things I'm going to be watching very closely in the months to come.
Well, okay, I mean, that is fair. Historically, consumer sentiment is a leading indicator. But like Powell, he wants to say, let's wait and see.
Hard to know for sure what consumers are going to do, but you talk to business leaders all the time. What's the general attitude of CEOs right now about business outlook and about their plans for, say, hiring or even raising prices?
So, we actually have started to ask our business leaders exactly this question. Where do you think pricing pressures are going to go, higher or lower? What we've heard consistently is they think they're going to go higher. Then we ask, what do they think is going to happen in terms of their sales? And they're also quite bullish on the sales rising as well, which says to me they think that consumers are going to be able to manage these higher levels of prices and whatever changes in prices that happen moving forward. We'll have to see if that actually plays out. I think that would be one of the big questions and stories that emerges through the course of 2025, namely how the consumer manages in the face of these elevated price levels.
Well, it is true. Business sentiment, while it has weakened, overall is still very optimistic. And I think this is why, and we've talked about this in other videos, you have a lot of companies that are saying, hey, we're going to invest bigly in the United States. Hey, please don't tariff us, bro. Like Hyundai announced, hey, we're going to build a steel factory in Louisiana. And then Trump is like, good, son, we won't tariff you. Okay, he didn't say the good son part, but basically, we won't tariff you. This is, what Trump is trying to get, because Trump gets credit for these new investments, businesses don't get tariffs, so it's sort of a win-win. But the question is, when are you actually going to deploy that capital? Are you just saying it while you wait for the uncertainties to go by? Oh yeah, we're optimistic, we're going to build, and then what if you don't? This has happened before. In the past, during the 2018 trade war, companies have done this, like Foxconn. Oh, we're going to do $10 billion of investing. They only ended up doing $700 million. So TBD.
If companies are saying prices are going to go up, are they going to pass that along if tariffs come on and add to the cost of their materials?
Well, we've done surveys to ask this question as well, and what we've gotten in survey responses is yes, they're expecting to try to pass these through. The expectations about unit price costs going up is clear, but if you look at in our surveys about what they're expecting for price changes, the amount of price change they're expecting almost matches the cost change one for one, which says a complete pass-through is the expectation. And then again, we'll have to see what happens in terms of whether consumers take that on board.
What are they telling you about the labor market and their plans for employment going forward?
Well, labor markets, they're still tight. Not as tight as they were 2 years ago, but what we hear from most businesses is that's not a source of worry for them. They feel like if they need workers, they'll be able to get them, and that wage pressures are not really outsized relative to where they were pre-pandemic. So folks are feeling pretty good about the prospects in terms of workers.
Businesses are feeling good. Workers themselves, less so. If you could freeze unemployment and the job openings level where it is now, yeah, you could actually probably be okay. You're most concerned about a further deterioration here, really.
Border crossings are way down and deportations are supposedly ramping up. What do you hear from the service industries about their abilities or even construction to find workers?
Well, we haven't been hearing this as an across-the-board thing, but we are hearing from particular sectors that there is a shortage that's starting to emerge in terms of work crews on housing construction sites and the like. We're just going to have to watch to see if that remains isolated or whether it becomes something that is more widespread, which then will have implications for the ability of the economy to meet the demand that's out there.
You were talking about consumer sentiment. What do you make of the rise in inflation expectations, which at least in the Michigan survey has been fairly dramatic?
Well, As you know, for many, many years, short-run inflation expectations have really matched where people are. And I think seeing the elevated prices, hearing the talk about the tariffs, and hear the idea that tariffs push up prices, I think has shaped people's expectations in the short run. It's the medium and the longer term that I'm trying to focus on much more. There, the reaction has been far less dramatic, but to the extent that that starts creeping up, that'll be something that I'll have to worry about.
Fair.
Well, there was a lot of pearl clutching on Wall Street when Chairman Powell suggested that the impact of tariffs on inflation would be transitory. Would you use that characterization?
Well, I try not to use that word anymore. I will just say that. But I do think, look, we have to acknowledge that historically, when tariffs have played out, there's been a one-time jump in prices, and then the economy's returned to its usual trajectory, such that policy doesn't have to respond to it. For me, I think there is a question about whether that's going to happen this time. We've just gone through a period of elevated inflation, so it is very much on the consumer's mind. And I fear that they might be more sensitive to higher prices today than they have been in the past, but they might not. And we'll just have to see how that plays out.
Well, this whole question of seeing how it plays out, given how we're getting government by tweet and things change all the time, are you sort of foreclosed from acting preemptively? Are you going to be necessarily behind the curve?
That's a big one, and I want to hear this. But first, I want to show you this chart. No, it's not an ad. I want to show you this chart right here. It's the 5-year break even. And I think it's important to pay attention to because you just heard Bostic talk about longer term inflation expectations. And I drew this all the way back to 2020. So you got the pandemic over here. We're obviously, initially when we're in recession, inflation expectations are very, very low. So you can see this. We have seen an uptick in inflation expectations under Trump. We shot up quite a bit from the low of our unemployment crisis in September and October, getting a 50 basis point rate cut. During that time, we were sitting around 1.8 on inflation expectations 5 years out. Right now, that's risen to about 2.6. Now, that is in alignment with roughly where inflation sits right now. So yeah, in fairness, long-term inflation expectations haven't moved up from its sort of alignment with where inflation is, but they've certainly gone up quite a bit from, when we got a 50 basis point cut from the Fed. So this idea that, the long term hasn't moved much, it kind of has. So it is something to pay attention to, and hence why I think this preemptive question is also important. So back to Mac. Okay.
I don't think we're going to be behind the curve, mainly because we know we're waiting. And so from my perspective, the longer you have to wait, that means your actions when you decide that it's clear where the economy is going are going to have to be larger than they would be otherwise.
Okay, interesting. This is the second person we've heard say this now. Last week, Goolsby told us, when we act, we're going to act bigger. This is really interesting because the Fed's basically telling you, hey, we don't know what's going to happen, but when it happens, we're going to have to move a lot bigger and faster. Very interesting because it stands in such contrast to obviously, the buy the dip momentum that we've seen and markets skyrocketing today on this idea that tariffs might be slightly less bad than expected. And the Fed's sort of like, that's great. If there's a shock, we will come in hard and fast. I guess it's good. It's some form of a Fed put, actually, if you think about it.
So I would say we don't want to it's not in our interest to move in one direction, find out that the economy is going in a different way, and then have to undo that.
Right.
I'd much rather take the time, make sure that when we act, it's acting appropriately to where the economy is, and we can make sure that we stay close to our dual mandate objectives.
Fair.
Now, you produce the GDP Now number from the Atlanta Fed. It's gotten a lot of publicity lately.
Okay,
Yes,
here
it
we go.
has.
Not for
Talk about gold, baby.
it's cheery news.
Because the numbers gold adjusted, Atlanta Fed GDP wouldn't be negative. It would be like positive 0.4%, which is still pretty bad, still pretty low.
But even adjusted for gold, it's sort of unchanged, which is a big drop from the growth rates we've seen. Do you think we're in the midst of a real slowdown, or was this just sort of a temporary dip at the beginning of the first quarter?
Questions?
Well, we'll have to see. GDP Now is a nowcast, so it takes data as it comes in through the course of the the quarter, what I would say is the drop from the 2.2% down to anywhere from 0 to 0.5% is a sign that suite of data, that set of data that came in, is suggesting slowdown. We'll have to see what that looks like for the end of the quarter. I will say most businesses I'm talking to aren't reporting to me that they're seeing that kind of a slowdown, so we'll just have to wait and see what happens.
Well, if the economy slows a lot, which would suggest maybe that lower rates are needed, but inflation hasn't come down to 2%, and you want to have higher rates to quell inflation. If you have that sort of stagflation, which do you choose to act on?
Well, I'm not jumping to stagflation yet, so I'm just going to say that. But I've been saying for a long time, it is paramount that we get inflation back to our 2% target. That's the thing that I'm laser focused on. To the extent that the labor market...
This a little bit is like, this is when they get into sort of these stagflation arguments, the conversation gets a little older. Now, we'll keep going with this in just a moment, but it's worth remembering that when they get asked about stagflation, you're almost better off just fast forwarding a little bit, because here's the thing. That is the worst case scenario for the Fed, where they can't cut because you have inflation. So they're always going to punt this. Always. Okay, at this point, they just talk about a whole lot of nothing. You don't really get anything useful out of this. Punting questions about Donald Trump and all this other nonsense. There's really nothing else useful in this. Bottom line out of this, you have people at the Fed who are like, confidence is down, but, from what I'm seeing, everything's fine, so we're going to do nothing, bro. And it's like, all right, that does mean the Fed could potentially be late, but it does mean, and this is now the second Fed person to say, hey, if crap hits the fan, we're going to have to move faster. Kind of interesting. So then the question is, how do you play that? Well, in my opinion, you want to be prepared for when the Fed goes U-turn. You want to be ready to buy, because usually when the Fed goes U-turn, it's moon time for real. But that's often at the point of panic, when people have lost their jobs and they don't have cash available because they spent all the money that they had buying the dip too early.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.